Good afternoon, everyone, and welcome to our third installment of our FI Live series here this year in 2026. My name is Leslie Mondesir. I am the Member Solutions Manager here at the bank, and I am joined with Drew Simmons, our Oklahoma Regional Account Manager. Before we get started, a few housekeeping items. The session today is being recorded. We will send a copy of the slides and a replay link following the webinar today. Please use the Q&A function at the bottom of your screens to submit questions, and you can receive one CPE credit for engaging in the poll questions that we have today. And with that, I will turn it over to Drew to get us started on our economic update.
Thanks, Leslie. So we'll get started here just with a macro view of what's been going on these last few months since our last FI Live conversation on the markets. Quite a bit has changed. Certainly, a lot of that stems around the war in Iran, and that's changed really kind of where interest rates have been heading, the growth outlook for the United States economy, inflation, et cetera. Just to kind of start the conversation regarding where the Fed's at. Clearly, in the last meeting, they decided not to hike or cut the Fed funds rate. Similar to last year, we started the year thinking there was going to be a number of rate cuts throughout the year, but that has certainly taken an about face in the face of inflation. The inflation outlook right now is certainly higher than where the Fed wants it to be. That arbitrary 2% handle that they're keeping their eye on when it comes to their preferred measure of inflation, PCE, stands at about 3.6% right now. And keep in mind we've been over that threshold for going on more than 5 years. So, a good amount of that has surfaced lately due to some inflationary indicators as a result of the war. Certainly, costs at the pump have been increasing, but a lot of other sectors have been impacted as well. When it comes to the labor market is pretty stable. We did get initial claims this morning. No real surprises there. Unemployment rate remains pretty stable. The participation rate, however, is very low. 61.4% is one of the lowest prints on record. And so there's a lot of folks out there that might just not be in the labor force right now. Kind of no hire, no fire. We talked about that during our last conversation. So things aren't bad, certainly, when it comes to the labor market, but they're pretty stagnant. Speaking of stagnant, GDP came out with a pretty bad revision at 1.5%. There was no surprises to that print, but certainly far lower than where we would like to see growth here in the United States. On the housing front, it's still a supply issue as well as just the cost of financing. Interest rates are still stubbornly high, and that is elevating mortgage rates. Folks are not really selling, and not too many buyers out there, especially when it comes to home affordability, which we certainly concentrate a lot of our efforts on here at the Home Loan Bank. But before I get on to the rest of our slides regarding the economy, let's just go ahead and open up our first poll question. And it's just what your expectations are with the Fed funds rate by year end. Do you think it's going to be lower than we are today, higher, or no change? Let you guys go ahead and fill in your answers there. And again, this is definitely just seeing some of these poll answers coming in as we wait for those to be completed. There's most of the participants at the first of the year thought we'd see a lower Fed funds rate, and now certainly we're seeing about 41% of you think it's going to be higher, and about 50% of you think it's going to be the same as we are today. So we'll go ahead and end that poll. But like I said, an about face, a much different outlook than we had just 6 months ago to begin the year. Okay. So yeah, looking at Fed funds futures, this is the warp screen on Bloomberg. You can see those expectations. During the last Fed meeting, there were three dissenters. meaning that they thought it was warranted to go ahead and hike rates by 25 basis points due to the inflationary outlook. Those folks have been on the ticker lately talking about that again. I would imagine you'll probably see even more dissenters if they do not make a change in the meeting on September 16th of next month. It just seems like more and more activity has been talking about the concerns with inflation and trying to get ahead of it and hopefully slow things down before it's too late. So, yeah, again, started the year with thinking we'd see quite a few cuts, and now here we are now kind of talking about potential rate hikes toward year end. Insofar as the rest of the yield curve looks, this is just the twos and tens on the United States Treasury yields. We are back to our 2023 highs, which also matched the highs going all the way back to 2006. So before the Great Recession, before the 2008 financial crisis. Again, that elevates mortgage rates, borrowing rates, and at a time when we have a very, very large indebted balance sheet at the federal level, that interest expense cost is certainly very, very high. And that's what this picture shows. We're now at about 40 trillion in federal debt, and you can kind of see just the trend here. It was pretty consistent since the '08 crisis. We had multiple rounds of QE that increased the Fed's balance sheet, increased debt issuance, things like that. But really, the ramp up since 2020 has been significant. You can see that widening that's happened and pretty much have doubled federal debt in just the last 5.5 years or so. So that's certainly a concern, and especially as interest rates remain elevated, that interest expense component can be a lot more concerning than when we went through the '08 crisis during those QE versions of QE, because quite frankly that we had very, very low debt issuance expense, and so it's a much different environment now, and added on to the fact that we've seen this exponential increase in the overall debt burden. Just the trend in core PCE, you can see this here going back to 2016. Saw a pretty big drop during the pandemic, and then we saw that run up into inflation that was stubbornly high into 2023, and then it started to moderate a little bit and has been bouncing around ever since. But you can draw a line in the sand there at that 2% handle where the Fed wants it to be. I think a lot of economists, financial market participants really agree that 3% is the new 2%. And while they might not put that official narrative out when we look at the Fed minutes, I think reasonably, if we can start to see inflation dip below anything below 3%, would be welcomed, especially when we're talking about the average consumer that is dealing with issues at the grocery store, at the pump, et cetera. So, speaking of, inflation and where it's coming from, naturally, fuel, gasoline, those are going to be the biggest drivers right now. Sulfur, natural gas, those petrochemicals that are certainly impacted due to the closing of the Strait of Hormuz. But there's a trickle down effect, right? I mean, in order for grocery prices to come down, we're going to need to ship goods from one part of the country to the other. That means that fuel is going to be used, fertilizer, and for our agricultural focused banks, we've seen some pain there from our farmers and those that are trying to get their crops ready. But there's definitely a trickle down effect. It certainly starts with oil prices being elevated, but impacts a lot of these other sectors in the economy as well. Again, GDP came in very low, 1.5%. Last year, we were clipping above 4%. Quarter two and quarter three of 2025 were very strong years for GDP. And then quickly into the fourth quarter, that came screaming down to just about 0.5% growth. Saw some improvement in Q1, but now we're starting to see that next revision come down a little lower at 1.5%. So not what we want to see when it comes to GDP. Don't want it too high and have inflation running it at a hot pace, but we don't want to see it as low as we're seeing these prints here lately. When it comes to home prices have been on the rise these last two prints, just the Case-Shiller index. Now, keep in mind that's the 20 city composite index, so it's going to include more of the larger metropolitan areas. But when we're visiting with members in our four-state region, it doesn't matter if it's in smaller communities, larger communities, home prices are still a challenge. And supply, as I mentioned earlier, is the biggest challenge to that. So, you might see home prices start to come down in correlation with supply turnover. But right now, these last couple prints have shown that home prices are, in fact, on the rise again. And at the end of the day, supply is just running at a dismal pace. It's been bouncing around that, 4,000 units, 4 million units of existing home sales in the market. It's being driven by a number of factors. We know that a lot of folks out there are sitting on very, very low interest rates as well as very low, initial purchase price, right? You might be sitting on a lot of equity. Maybe you're able to tap into that. It's very difficult for folks to see any mobility incentives when they're sitting on a mortgage payment that would be astronomically higher given today's interest rates and home price environment. Okay. New home sales also are pretty flat. So, existing homes and new home sales are not seeing much notable improvement here. There's a lot of noise in the data when it comes to new home sales. There's certainly some seasonality. We saw a lot of increases in new home sales following the pandemic. But since then, really, for the last 4 years or so, new home sales have really not materially improved. And this year is definitely lower than it's been in quite some time. Okay, go ahead and move on to another couple poll questions to round out our discussion on the economy today. And let's start with what your overall outlook is for your just local economies. We're talking about the markets that you serve. Are you seeing strong economic activity? A, moderate economic activity. B, a weakening in economic activity. C, or you see it as very weak in today's market. Okay, I'll go ahead and let those answers filter in a little bit. Looks like most of you that answered before are just about done. Okay. All right, we'll go ahead and end that. Well, I guess we have a secondary poll here. I didn't address it yet, but it looks like most of you have answered that. And it was just the biggest concern you have for the local economy. This is a recurring question that we've asked before: inflation, housing affordability, unemployment, and rising delinquencies. So, in summary, when it comes to your outlook for your local economy, most of you see it as moderate. That's mostly what we're hearing, just kind of boots on the ground, talking with members on a day-to-day basis. About 60% of you feel that you see a moderate outlook for your local economy. Only about 6% are seeing it as a very strong economic activity for your local markets. And then 35% of you see it as weakening. No one selected very weak, so that's good. But certainly the 35% of you, a little over a third of you in the room today, see it as trending into weak territory. Insofar as your biggest concern that you have for your local economy, the biggest issue is now back to inflation. We've bounced around here in these kind of overall sentiment from you, dipping into concerns about delinquencies, concerns about housing affordability. Inflation really hasn't been a concern for quite a while. Now it is. About half of the room is saying that their biggest concern is inflation, followed by 36% seeing housing affordability as the issue. Very, very few of you, only 4%, seeing issues with unemployment, and about 10% are concerned with rising delinquencies. Okay, I'll go ahead and stop sharing that. You can see those results. Feel free to screen grab it. You can get these slides from us, and we'll continue to update you as these trends change. Okay, with that, I will go ahead and turn it over to Leslie for member financial trends and insights.
Thanks, Drew. Second quarter, some key takeaways. We did see the script flipped in the second quarter for institutions with deposit growth stalling or contracting after a really strong first quarter. Welcomed loan growth. We saw at credit unions for the second consecutive quarter after a period of no growth or contraction. And then we had a rebound at small banks after they experienced a sharp slowdown during the first quarter. Cash and interest-bearing deposits were put to work in higher yielding assets. For banks, that was primarily in loans, with a mix of members building their securities portfolio. For credit unions, that growth was seen in both loan and investment portfolios. Margins benefited from a steepening yield curve and higher market rates, but we did see interest-bearing deposit costs tick higher after seeing a trend of relief over several quarters. And although we had an unrealized loss position that continues to persist in member available for sale portfolios, the loss percentage has vastly improved since 2022 and 2023, when the Fed was raising rates pretty quickly. Asset quality continues to remain on really solid footing here as we continue through 2026. And on the next slide, we take a look at trends of loans to shares and deposits, and then liquid assets to assets. Banks are there in the black lines, and credit unions are that lighter blue. You can see that for loan to deposits, we've really kind of stayed within this band over the last couple years for trends and loan to shares and deposit at a more elevated level compared to historical trends back 10, 15 years ago. On a year-over-year basis, deposits grew 5% and loans grew 5.6% at banks. For credit unions, we had a 3.5% share deposit growth and 3.6% loan growth at credit unions. So more in line with credit unions, and then a little bit of difference in growth there, funding gap for our bank members between loans and deposits. On both a quarter-over-quarter and year-to-date basis, growth in deposits was primarily in those non-maturity accounts for banks. Same for credit unions on a year-to-date basis. And although the median that we saw for loan growth was strong, there is some cohorts of members where we did see loan balances decline for about 30% of our depositories, and that was mostly smaller members. We did see contraction in loan portfolios. Credit union loan growth was driven primarily by 1 to 4 family residential lending, followed by another solid quarter in auto lending. Bank lending activity was concentrated primarily in commercial C&E, CRE, and C&I, followed by ag and residential lending. So as I mentioned, wholesale funding gap, it continues to fill that funding gap. The number of members that are using advances and other sources of wholesale funding continues to grow, but our balances have stayed pretty consistent. On balance sheet liquidity metrics, they're on the right, they remain generally lower compared to historical trends for banks, trending slightly higher for credit unions. But the amount of pledged assets has grown notably over the past few years, reflecting that shift in balance sheet positioning and liquidity management as the ability to access liquidity has become critical. All right, another question, poll question here. These are questions that we tend to ask on a regular basis to kind of gauge the sentiment for each of your institutions on what your loan growth expectations are for the next 12 to 18 months, along with your deposit growth expectations in the next 12 to 18 months. Are you expecting strong, moderate growth? Get the poll questions up, and then, or are we seeing expecting maybe some slowdown or weakening in loan growth, that demand, or in deposit growth, what are we expecting? We asked this question, I believe it was in February, and the response that we got was about 50% of those that responded were expecting some moderate growth. Loan deposit growth expectations weren't quite as high, so continue to expect a little bit of a gap there between loan and deposit growth expectations. And looks like I think We're about at how many have answered. And I would say it's consistent loan growth with what we saw before when we had the poll. Maybe a little bit of pullback. I think we had a little bit stronger growth expectations 6 months ago. Um, and then on the deposit side, again, deposit environment continues to remain pretty challenging to grow deposits. And moving to our next slide. All right, here we're comparing net interest income for the first half of 2025 to 2026. So first 6 months of net interest income. This rate volume analysis is used to understand why that net interest income changes, where the change came from, and what are those earning drivers. The banks are on the left, credit unions are on the right, and that heading for credit unions, it says 24 versus 25, but it's the second half of 25 versus the second half of 26. Um, as you can see here, the large gray bars on the left side of each graph, the volume of loan growth was the largest single contributor to an increase in net interest income. And when looking at just deposits, the decline in rates paid on deposits, it has offset the interest expense associated with that deposit growth for banks. Both growth in security portfolios and higher security yields contributed to growth in earnings. And if we'd like this to run for your specific institution, please reach out to myself or your account manager, and we can take a look at how your bank over a certain time period, the change in net interest income, and can also compare to peers if that's something that you are interested in. And on the next chart, we're going to look at margin performance. That black line in both charts continues to push higher. And that continues across the industry. The blue line is going to be cost of interest-bearing deposits. At the median, margins improved 9 and 10 basis points for banks and credit unions during the quarter. For some comparison, the top quartile margin for banks was 4.42% and above, and it was 5.4% for credit unions, just to kind of get an idea of the range and distribution of margins across those institution types. On the funding side, you can see the blue line, it stalls and it slows. The cost of interest-bearing deposits, definitely more of a lag on the way down as rates move down since the end of 2024. Cost of shares deposits, I mentioned, they moved higher, 2 basis points for both banks and credit unions. Larger banks, they did have greater deposit betas on the way up. So they've had a little bit more room to move lower, and they've moved lower quicker for both maturity and non-maturity accounts. And while the median cost of time deposits, those maturity accounts, those did move a little bit lower during the second quarter, the cost of non-maturity accounts increased during the second quarter at the median for both bank members. And we're seeing industry analysts, they're expecting overall deposit costs now to rise in the back half of 2026. It's a little bit different than what we had expected going into this year. Loan yields peaked in the third quarter of 25, but during the second quarter, that we saw that reverse in their downward trend. The lending market is expected to remain highly competitive, particularly on pricing and structure for those high quality credits, which could lead to some compressed loan spreads as we move throughout the rest of the year and into next. We do expect margins to still benefit in some cases from the repricing of rate loans and reinvestment of low yielding securities. Bond yields remain attractive, and they do present an opportunity to lock in some yield if loan demand slows. All right, kind of stick with the deposits here. Here's a chart where we take a look at all of the CD specials that are currently being offered within our district. Along the bottom is term, and you can see those blue circles are all, and that's for institutions, both banks and credit unions, where we can get rates. The distribution of those specials, highly concentrated on the short end within 12 months. Money fund CDs or Fidelity Vanguard that line that is right on top of our advanced dividend adjusted rates. You can see there how on the short end, there's some really many institutions continue to offer above market rate premium CD specials. You can see on the left-hand side of the chart. The black line is going to be your standard CD offerings, which is quite a bit lower. And as you would expect, and interesting that the shape of that curve is still inverted when we haven't seen that in other market uh, curves, such as the advanced curve you can see here. Um, Institutions continue to face renewed deposit pricing pressure, as hoped for rate relief did not arrive here early in 2026. Unlikely to happen this year, pushing institutions into an increasingly competitive battle for funding. Concerns about more deposit cost pressure than anticipated frequently center on banks needing to pay up for funding as loan growth outpaces deposit growth. Even if the yield curve is steepening, it's generally positive for the industry, but does put pressure on deposit costs. Where so you can see the money market promos, which aren't on this slide, but you open up and you go to Google and you search rates, and you're going to see a lot of competition for balances. Also competition from neobanks such as Chime and SoFi, fintech and institutional money markets and money funds. I went out and did some looking at high yield savings account rates. The max I found was 5%, and the top quartile of the 30 I looked at were just over 4%. So lots of attractive options out there. That and customers they're more aware than were before probably 10 years ago. Customer behavior, product mixes, technology, competitive dynamics, they've all changed and shifted. So data is very important in knowing what your deposit base consists of and determining where and how much you're willing to spend for growth and retention is crucial. The marginal cost of funds analytics those conversations should be continuing in ALCO meetings and pricing decisions um, to and how what strategies that your bank or credit union is going to deploy to continue to attract and acquire new deposits in an even more competitive world. All right, poll question. What primary behavior have you seen with customers as their shorter term CDs mature? So we've seen this distribution of CD specials for a few years now, and those CDs are just regularly up for renewal every quarter, every 6 months. And we're curious to see what that behavior of those customers are, and maybe how rate sensitive are they? Um, are they rolling into the same or similar term CD, moving to a longer term, moving into a non-maturity account, or are the funds leaving an institution? Looks like most of the responses are coming in and they're saying they're staying short. And I've read industry research of some of the longer a CD rolls and matures, the more sticky it becomes. So paying attention to customers, those depositors, and there may be opportunity to shift some deposit pricing strategies, maybe down on some of those shorter term CDs, and those deposit balances are likely to stick. All right. I showed this slide a couple um, sessions ago. We offer this analysis, return on equity analysis. It's available for members. It breaks down what's really driving return on equity, and it decomposes the underlying layers of profitability. And we dig into loan portfolio, deposit portfolio, the mix, yields, and you can see how your institution compares to two different peer groups. We have the default peer groups, such as asset size, state, high performing peers, but we have the ability to customize a specific peer group for your institution that fits your profile. We can help you create a peer group based off your size, location, maybe the type of business. Are you an ag bank, a commercial bank, a residential focused credit union? We can help you put together a peer group and then walk through how your institution compares to peers in a lot of different components of return on equity. And we'll touch real quick on asset quality. Delinquencies, which are there on the right, they continue to rise as consumer debt remains elevated. On the left there, we have trends for non-performing assets for banks and credit unions. Um, the credit union median for non-performing assets, it is at 56 basis points and has trended upward, but this only goes back to 2012. That remains well below the peak of almost 90 basis points in 2010. Still solid performance there on the credit front. For banks, non-accrual loans, they were unchanged in the second quarter, but the composition of those non-accruals shifted as a jump. We had a jump in C&I non-accruals, which was an increase about over 20% during the second quarter. But that offset was it was offset by decreases in CRE and 1 to 4 family non-accruals. But for bank or credit unions, the jump in delinquencies at credit unions was driven primarily by used vehicle loans and residential uh, loans. So a little bit different shift. The decrease in 1 to 4 for banks and increase for credit unions. All right. Outlook in February versus the outlook in August. It has changed. What's changed is the shape of the yield curve, and with that, the set of decisions that now face every outco. Margin tailwinds are still working in your favor, but not driven necessarily by lower funding costs. Having some opportunities to grow or expand margin with the benefit of higher asset yields. Industry analysts, they've noted that margins may have peaked, but they see a flat to down slightly path. There's debate around margin and net interest income dynamics. It'll be interesting to see how the rate volume analysis changes from the first half of 26 to the back half of 2026. The view still holds on the challenging environment to grow shares and deposits. I read an article recently that talked about branch expansion efforts, especially with the largest national banks. Chase, they're building a new branch here in Topeka. They haven't had a location here before, which is interesting because Bank of America left Topeka a few years ago. So the competition continues just to evolve. And then can't forget to mention the lingering stablecoin topic and the unknown impact that that may have on deposits. Analysts, they continue to predict that loan growth will support relatively stable margins and earnings increases. However, loan growth expectations and pipelines, those could weaken if economic and market conditions deteriorate. We are hearing from more members that loan growth is slowing here into the back half of the year. Um, and Drew talked about the economy, interest rate outlook, and shifts we're seeing there. Of course, technology investment is a must. The M&A market, it's hot, it's busy. The regulatory environment is favorable for those institutions that are looking to execute deals and grow through building scale. An attractive opportunity for those banks looking to sell as well. But M&A can also cause some market disruption in local markets. When institutions they can benefit from, like acquiring new deposits and potential loan relationships as well. And again, access to liquidity and collateral capacity continue to be imperative going forward and as a continued focus for regulators. And it's something, if you've attended our RMs in Nebraska and Colorado, you heard FinPro talk about liquidity, uninsured deposits in the regulatory landscape around borrowing and building capacity. With that, we will turn it over to one more poll question. What are your top financial concerns? You can choose three, I believe. And then also, what are your top challenges facing your institution? So, from a financial standpoint, there for the first question, cost of funds, liquidity, deposit growth, loan growth, asset quality, capital, or interest rate risk management. For the last time we asked this question, it was cost of funds, deposit growth, and loan growth were the three that received the most votes. And as votes come in, deposit growth certainly seems to be the highest. It's that environment continues to be pretty challenging. And top challenges, succession planning, technology, and speed of change. We face a lot of those same challenges here at the bank. And it's certainly a part of many discussions. Cybersecurity, fraud, talent acquisition, retention, um, especially in the banking industry. And we don't just see that in our district, we hear that from our other sister banks as well um, within their districts. Right. We can end that poll. Cost of funds and loan growth. Interesting cost of funds. Yes, we've seen that in the second quarter numbers. It did fall out of the top three the last two times we asked this. But like I said, that it's reignited as consumers are more aware of rates and their ability to move money is just quicker. All right. With that, Drew, I will turn it over to you.
Okay. Thanks, Leslie. Okay, we'll cover liquidity and funding strategies here. Again, we're back to a pivot, so we're almost back to the drawing boards. It feels like, and that's not normal, given that we're more than halfway through the year, but it definitely warrants a different conversation than we started the year. So, higher for longer is back on the table. So, when you're thinking about your incremental funding needs, do you want to, look to stay short or extend or consider maybe a blending of your funds for your overall funding strategy? It depends on, your outlook, your overall structure of the balance sheet. All those things certainly are always considered, but it's probably different than the conversation that you had earlier on in the year. So, identifying any pain points that you have on the balance sheet, struggles that you're having now that you weren't having before, and how does that fit with different rate shock scenarios? So, we started with kind of this bull steepener in the curve, and now we're looking more into a bearish flattener. And if we do start to see those lower end rates, those shorter term rates, especially driven by any Fed decision to hike rates, that bear flattener will continue, and the inversion of the curve will be exacerbated. So you can also look to improve your earnings on the liability side of the balance sheet, finding good, opportunities in various costs of funds. Many of you participated, for example, in our LEAP grant funding program this year that offered you a very, very attractive funding position with those qualifying funding projects or even investments in the municipal space. So always trying to kind of be nimble, staying on your toes and evaluating those opportunities to stay invested, stay in the market, and not, be complacent or fall victim to that wait and see strategy. Are you carrying a balance on our overnight line of credit? Might want to start considering moving some of those dollars around to other shorter term alternatives. We've seen a lot of folks move out of that and into a shorter term SOFR adjustable structure. We've seen a lot of interest in our puttables lately. Again, I think a lot of folks are kind of scrambling to find just a basis point here, a basis point there to overall improve your funding position. Our advances are a very strong alternative to brokerage right now and other alternative funding sources. So it can certainly complement your retail CD funding strategies as those pain points remain, as you answered in Leslie's question earlier. Also, maximize your borrowing capacity. We still run into folks that run a little thin. When it comes to their available capacity with us, and we are always available to talk through that strategy with you to make sure that everything is on the table that you can, pledging as much as possible and allowing for you to be that much more flexible in the event that you need to utilize that capacity. Here at the bank, we've got a lot of asset-based liquidity strategies we can help you with, using our letters of credit to secure deposits. So when you're talking about maybe increasing your reach in the deposit space, and you want to maybe look at some of those public funds, I can tell you as a former public finance banker, municipalities really do love the Federal Home Loan Bank's letters of credit. They're easy. It's one and done. You don't have to worry about any sort of daily pricing when it comes to comparing pledging like securities and things like that. You don't have to worry about the changes of the valuations of those securities, pay downs, calls, etc. So it's no secret and it's no surprise really that the our members that have the largest share of public funds are also the ones that utilize our letters of credit the most. Looking to maybe sell 1 to 4 family loans held in portfolio originated just in the last couple of years into our MPF program. That's immediate income for you. So you can talk with Chris Endicott about that if that's something you want to engage in going forward. Just kind of a reminder of the broader areas in which you can access our funding. We have our standard bullets. That's just an opportunity to place some money on various parts of the curve, capture maybe some potential rate cuts. Right now, as we talked about earlier, that's pretty much off the table in the interim. But depending on your funding strategy, bullets are a nice, clean, easy way to put some dollars out there to work on the liability side. I just mentioned our SOFR adjustable that reprices daily based on SOFR. But with that repricing daily, sometimes you can not have to manage the overnight line of credit as much. So it's a good alternative there. And depending on your rate outlook, you can look at maybe a 3 month or something more on the shorter end. That's mostly what we're seeing with that particular product. Not many folks are going long on that product and allowing to ride the curve as it stayed sort of range bound here lately with the Fed being on hold. And certainly if they continue to be on hold, that would be a very good strategy and can pivot as you keep those short if the Fed moves into a rate hike uh, situation. So mentioned the puttable earlier. Again, a lot of folks are looking into that. You can see the attractiveness on the pricing there. Gives you some margin relief with some immediate cost savings for now, and then hopefully maybe a cushion for rate moves lower into the future. Some of you are still taking advantage of the anchored high yields in the bond portfolio or bond market rather. I covered that in looking at just the long-term treasury bonds there where we're seeing the highest yields in quite some time. This morning, I was just curious working here at the bank and jumped on Bloomberg and seeing where some of these municipal bonds that I used to work in and see how on their price. And I was shocked. I mean, tax equivalent yields for moderately duration priced munis are, seeing 7% handles. And these are high quality credits. We're not talking about junk bonds. We're not talking about some of the lower tier credits. So, even with the curve experiencing a little bit more of a bearish flattening, the longer end of the curve, you looking out at 8, 10, 12 plus years, has some very, very attractive yields. So, we talked about this. We began talking about this Q4 of last year, where you can identify the cash flows that you have already rolling off the bond portfolio, and then taking out advances, utilizing those cash flows to pay down the advances in sequential terms, and therefore you've unwound those borrowings within a relatively short time. Most are doing it, anywhere from 9 to 12 months or so. So keeping it about inside a year and going ahead and using the advances to purchase those securities, anchoring in those yields. Certainly that's more common with your lower loan to deposit ratio institutions. So if loan demand is slowing, trying to hedge for potential continuing of that slowing in loan activity, you can anchor in those yields in the bond portfolio today using a pre-funded strategy and our advances. Okay, let's go ahead and open up a couple more poll questions here. So with the enhanced focus on liquidity by regulators, are you looking at ways to increase your capacity with the Federal Home Loan Bank? Yes, you need to. Working on it? No, I don't know. Second question, where are you concentrating your funding needs? So just looking at terms, are you staying inside a year, 12 months to 3 years, longer than 3 years, or a combination thereof, blending your terms, a blended funding strategy? Okay. Regarding the first poll question, looks like about split evenly between working on an enhanced focus on liquidity for your institution and no. I imagine many of you that are answering no, you've already tackled that issue. We've had plenty of liquidity concerns over the last few years, so many of you have already implemented an updated policy maybe to your overall liquidity strategy and how you're talking about it with regulators, how you're talking about it in ALCO, and how you're implementing strategies at the level of your institution. Very few of you said, I don't know. Insofar as where you're concentrating your funding needs, no surprise here. About a third of you are in that 12 to 36 month range. 23% are keeping it inside 12 months. Nobody has answered beyond 3 years. That is not a surprise from us. Blending of terms, some of you looks like are doing that, about 23%, and about 20% of the room is not in a borrowing position. Okay, I'm going to go ahead and close that poll there. Okay, letters of credit. I just talked about this, but if you're not utilizing it, and you want a little bit more information from us, please don't hesitate to reach out. Again, I'll reiterate that the folks that use these the most are using them for largely their PUDs. They tend to have a very large share of public funds, working with local school districts, city, county, you name it, any of that money. One thing that I want to point out with letters of credit, sometimes, especially in our more rural-based institutions and members, they might be working with like a school district, and the superintendent is unaware that they're allowed to use our letters of credit. And they've always maybe used pledging of securities. We are happy to provide education with any municipal official, whether it's a superintendent at a school or a CFO or finance director, or even we've talked with city managers and folks to look into their own internal policies to make sure they're refreshed because they are allowed in our district in each one of the 4 states. And so we do run into that from time to time where municipalities might not be aware that that is allowed at the state statute level. So but some of the benefits are, you can free up some of those securities that you're pledging, increasing your overall liquidity position if you want to use those securities to drum up some liquidity in the future. Again, they're widely accepted, as I mentioned, and it's just incredibly easy. When you're pledging securities, there's nothing wrong with doing it, but you do have to usually provide daily pricing from your broker dealer. There's a cost, of course, with that, and monitoring market values and repledging. Oh, looks like this bond got called or matured, and we need to find something to replace it, or overall pay downs in the mortgage or CMO portfolio that you're pledging. So it doesn't take just the most headache in the world, but sometimes it can feel like a death by a thousand cuts. So yeah, consider mixing in some letters of credit to garner some of those public funds on the deposit side. Okay. This is a report that Leslie and her team put together, just talking about strategies when it comes to letters of credit and trying to improve your liquidity position and maximize earnings. We can easily run this for each one of our members. So if it's something that you'd like to see on your end, just let us know and we'll put it together for you, and you can have those discussions in ALCO. I've got a hyperlink here. You can go ahead and request that right now if you'd like to. We do not mind being bombarded. We're here to help any way we can. So happy to get that out in front of you if that's something that you think would be useful for your institution. Okay, so some thoughts from our lending desk. They're always busy talking with you on a regular basis. So one thing we always encourage our members to do is make sure that the roles in the members only portal are up to date. A lot of times you have staffing changes, different roles change at your institution. And so make sure that that is up to date. So that way, if anybody's out, you've got all the approvals and permissions and everything that you need on the members only site. I mentioned earlier, we're seeing a renewed interest in the puttable product. Markets certainly intraday, intra-week, and over this year have been, relatively volatile. Rates are mostly range bound, but the volatility, the intraday volatility has changed quite a bit, and the puttable tends to take advantage of that volatility, capturing a little extra yield discount on those structures. We have a lot of different custom structures that we can build for you. The ones on the rate sheet are not the only structures we have. There's just only so much room we put on those rate sheets. So certainly, if you have a more nuanced, way you want to look at it than you're seeing on the sheet, we can certainly drum up some structures within our capacity and ability there for you. But more and more, we're seeing members utilize the puttable advance. Also, even though you're not in a borrowing position, we always encourage members to test your line, call in to the lending desk and make sure you test their line. That regulators certainly like to see that you've gone through that process, that it's not just something that's been collecting dust. And even though you're not in a borrowing position, that you're very much aware of the process and have already reached out. We recommend that you do that at least annually. Okay. With that, I'll let Leslie kind of take us home here and wrap us up.
Awesome. Thank you, Drew. If you can go to the next slide. Want to remind everyone that our 500 for Good, the window to submit a project for $500 is open, and it does end on Monday, the 31st. For 8 years, we've partnered with our members to help fund your passion projects across the district. Together, we've donated school supplies, planted trees, we've thanked first responders, and improved downtowns. Anyone from your institution can apply for this $500 micro grant to benefit your community, and winners will be announced this fall. All right, MSU Denver, FHLBank Topeka Affordable Housing Institute. This opened in 2025. The Institute, it educates, it prepares the next generation of affordable housing lenders. To support continued learning in affordable housing, we introduced full scholarships for members and housing partners for MSU's fully online course, Introduction to Affordable Housing Finance. The course meets each Wednesday for 1 month. Sessions are available in September, October, and November. So if you have an individual at your institution, this may be a great learning opportunity for them. It's for a month long and once a week. The course is designed to provide a foundational understanding of affordable housing, what it is, what it isn't, how it's funded. It's not a finance class, but it helps gain knowledge on the affordable housing industry as a whole. So we do have scholarships available. There's information. The link is here on the slide if you'd like more information. And again, sessions are in September, October, and November. All right, save the date. You'll get this again from us in December. But we want to continue to promote our annual member conference. It'll be next April 21st through the 23rd in Kansas City. It's a 3-day education, networking, entertainment opportunity. It will be the 29th year of us hosting the conference. It's a great opportunity to meet with us, put faces to names, for us to put faces to you all as well, and the ability to interact and network. And then remember that your attendance today will enter you into a drawing for a free registration for the AMC in 2026, and all attendance in the FI Live series this year. So for the one in December as well, you could be entered to win a free registration for next year. And one more event we have for our Oklahoma members, upcoming in October, Thursday the 15th, our regional meeting. It's at Shangri-La Resort in Monkey Island, Oklahoma. The agenda is listed there on the right. We have Russell Evans back to provide an economic update for the region and for Oklahoma. We'll announce our regional housing champion for Oklahoma. We are doing a panel again of Federal Home Loan Bank staff to discuss topics facing the system, what we're hearing from members, and to answer any questions that you may have. And then we will have FinPro with us this year, Don Musso. He'll provide a balance sheet strategy and regulatory issues presentation, like I mentioned earlier, focused on liquidity, funding, uninsured deposits, and then kind of regulatory landscape that they meet with regulators pretty regularly, and they'll provide an update on that. And then finally, a golf tournament following the morning um, half-day conference setup. And then there's a link there to register. Check your email. Also on our public site, there is a link to register as well. Our member solutions tools and analysis page out on the public site, there is a link under resources and member only as well. Mention that we did add a new page to the landing page here, which includes descriptions and examples of all the tools that we have available for you all to request. Like the tools we've mentioned today, marginal cost of funds and deposit portfolio pricing analytics, return on equity analysis, letters of credit tool that Drew showed. We also have advanced funding comparisons. So if you have an upcoming advance or brokered maturity, or you still anticipate a need for funding, contact your account manager to discuss funding options and scenarios under various rate changes or scenarios. We're happy to come join your ALCO and walk through some of those funding strategies that are specific to your institution. And then listed on the slide here, they're the top one, liquidity stress analysis. We didn't talk about that today, but it's probably our most popular analysis that is used by members. We can customize it, the assumptions to your institution. And then it's not on the example there, but we can add other wholesale funding sources to get a better whole picture of your total liquidity position. And we have members that do share that with their regulators to demonstrate some of the stress scenarios that they do run. All right, here's a list of the contacts for us here at the bank. We hope you've walked away with something today that you can take back to your institution and share. So again, if you have questions, please feel free to reach out to your account manager, myself, the lending desk, or HCD department. And that's it. Yeah.
Thanks everybody for joining, and feel free to reach out to us if you have any questions, you want us to share anything that we covered here today, and we will look forward to visiting with you guys for our last quarterly webinar of the year,
In December.
December
And we will
2nd.
have our CFO, Phil Backus. He will be joining us in December to provide an update on the bank and how the year has gone and what we're looking into for 2027.
Thanks, guys.
Thank
Take care.
you.